can start in a few minutes, I hope.
Yeah.
Give me a few moments. So,
Okay.
how's it all going?
Well, for me, I've obviously having a shit year, but you know, I think I play the cycle. I always get the bloody timing wrong, frankly, and it's just a question of waiting until the cycle turns. And frankly, inflation has been much more persistent than I expected. And again, we got EU numbers out today. Inflation is hardly coming down, but if you look at the underlying, the economy is definitely slowing. And you saw the failure of First Republic Bank in the US. The regional banks in the US are selling off. There is undoubtedly a credit crunch coming. I think we have recession in the second half. Maybe it's Q4 rather than Q3, but you know, it's inevitable in my books, and that means that when you look at equities, I would be going defensive. And in the when I look at so regular viewers of the podcast will know that I sold out of my energy stocks back in May last year. And actually, when I go through and calculate the P&L, that was a good decision. The moving into long dated gilts, less of a good decision. But I think if we get a recession, the oil prices crashes. We've seen oil down 5% today, and I think there will be buying opportunities over the next 18 months.
Yeah, I mean, I'm fairly defensive myself, but most of what I do have left is oil stocks. But
Right.
I was actually having a look at them today and thinking, is it time to, I mean, to be honest, I'm kind of still holding on to them mainly because they're the only thing that's left. And I kind of almost feel a little bit hesitant just to completely be just 100% cash. But still, yeah, I was looking earlier at the Total Energies and Shell, and sort of thinking, But yeah, well, my actually the punchline to this at the end of when I do my summary is it's better to be late than too early. So I think I'm
Yeah,
kind of
well,
with you there. Hello. So thanks very much, Keith. And that sounded like a really interesting discussion about oil price, and it would be perhaps good to revisit that later on. So I'm just going to give my quick summary. Every quarter, I do a bit of a macro update for myself, and I then use that to decide what kind of percentage of my portfolio I want to be on risky assets. And so this is the front page. This is a family show, so it's just a bit of satire, really. So I won't go into any detail there. With this being a family show,
who's the bloke at the top?
so that's Klaus Schwab, who's the head of the European, the World Economic Forum.
Oh, right, okay.
So, like I say, it's a family show, so I'll just move along.
Well, we're all adults here, right? The more swearing, the better. I would have thought, frankly.
So, moving swiftly on. So, when I go and look at my macro and the FTSE 100, I always like to zoom out first of all the way back to 1985, and here you see the long-term trend, where quite clearly the price of the FTSE 100 does go up on a long time, as it does with all the other Western indices. And that, of course, makes sense because you have GDP growth every year of, typically about 2%. And also, you have inflation. So that's why, it just makes sense, this trend. And
Well, so just to come in here, this is kind of what I about technical analysis, because you're right. There's economic growth trends up, but nominal economic growth rises, and so there's a straight line you've drawn here, but we know over the last 2 years we've had 20% inflation. So surely earnings should have gone up 20%, and the all share FTSE 100 should have gone up 20% as well. Why does it have to be a straight line in a normal chart? Why shouldn't it be a straight line in a log chart, for example, which would be, you talk about 2% increase every year, then you'd have a parabolic chart, and actually you'd need a log chart to produce a straight line. So
you're saying, sorry, why should it be logarithmic? Why should it be exponential?
right, if you have 2%, let's say a theoretical economy grows at 2% a year, yeah, then it will grow in a parabolic curve. Yeah, it won't grow in a straight line, because after in year 2 it grows by 2% of 1.02, which is slightly more than 2%, and in the next year it grows at 2% of the compound of that. It compounds up, so you get a parabolic curve, and if you want to draw a straight line in that, you need to use a log chart.
So, so you're saying that actually the FTSE 100 we should be seeing an exponential increase.
Yeah, if the economic growth was steady, like 2%, then the economy will grow, is an exponential function, and you should expect share prices to follow the same. So, this is one of the problems I have with technical analysis. Basically, I just think quite a lot of it's arbitrary.
So, okay, I mean, interestingly, what I've got here is, what I've done is here I've measured the GDP of the US, measured in US dollars, and then measured the GDP of the US measured in units of 10 million ounces of gold. And you can see that although in terms of US dollars, the US GDP has gone up incredibly, in fact, almost exponentially there.
Well, exactly. That's my point.
In terms of gold, it's not actually really increased in value at all. So, so you've raised an interesting question there about why does the FTSE 100 not raise exponentially? That you've kind of caught me off guard with that one. I'm going to have to think about that. It'd be interesting if anyone has an answer to that. But I mean, does anyone have the explanation for that wants to chime in? Also, by the way, Keith, have you turned on the comments?
Yeah, no, there is the comment section is live with C. Wyatt has already posted something. If I think you need to click on the chat function, I think, if you're on the call to see that. Simon W., our technical analysis guru, what do you think of the why should you be using a linear chart rather than a log chart? Can you explain?
Well, you shouldn't actually. You should be using a logarithmic chart.
Okay.
If you want to be technically correct, but behaviorally, people look at prices on a linear basis. So
Good point.
Technical analysis is really a reflection of behavior, people, actors in the market behaving some way or other. If they're looking at nominal charts on a linear basis, then they're looking at a linear basis, you know.
Yes, very
But
good point. Yeah.
theoretically, you should be looking at logarithmic charts. That's for sure. If you're judging your own price movement over time, not necessarily price action in short time periods.
Yeah, very good explanation. Thanks, Simon.
Okay, so I like to. So obviously, I'm drawing this not in a logarithmic, but in a linear scale, and we've got to somehow. There is the question: why is it not rising logarithmically? But the fact is, it does increase in this linear scale, and I've attributed this to GDP going up and inflation going up. And in reality, the actual total value isn't going up. It's just the inflation, actually. You know, the value of the pound sterling going down, perhaps. But still, there is a clear gradient here on the long term. And what's interesting is, in the olden times, you used to get these classic bull markets, you know, classic market bubbles form, and then they'd crash back down again. We got the dot-com bubble and then the credit crisis. But then since around 2009, that's when the government started doing loads of money printing and started having near zero interest rates. And from then, we've actually seemed to have broadly just stayed with this gradient. There's not like the massive market ramp ups like there were before. With then, however, when we had the Corona crash, that sent us down, but then we seem to have normalized back up to this gradient. You know, so that's me, just my interpretation of this, you know, as an amateur, really.
Well, as you look, before you move on, if you were to draw a line just from the tops, so drawing a line from the top of the dot-com bubble, you know, I think you would get something that went quite close. So if you draw a line from the, say, top of the dot-com bubble to the top of the Corona crash, you know, just before that, then I think, you know, that would seem to be a ceiling at which the FTSE struggles to break through, and I think we are actually quite close to that. And my own feeling would be that you know, we are towards the top of this particular economic cycle.
I think too that if you wanted to do a more in-depth analysis of that kind of thing, you should look at the real increase in the FTSE. So you should adjust for inflation. I think just looking at the nominal side is can be deceiving, as you pointed out on the logarithmic side. You know, if you don't deflate this, then it's a bit meaningless, really.
Yeah, no, that's a very good point. Given that we know since 2020, we've had 20% inflation, then surely we should be somewhere close to like 20% above the pre-corona crash level. You know, if things were equal in a nominal terms.
Yeah, so it would definitely be very interesting to look at these this chart adjusted for inflation, and that's yeah. So okay, so in this linear format, we see that for the FTSE 100, the actual gradient hasn't changed before and after the zero interest rates and money printing began in around 2009. And that actually contrasts with the FTSE 250, where ever since the money printing and low interest rates began, there was a sharp increase in gradient, and it's the same for the S&P 500 as well. So for some reason whereas most whereas the FTSE 250 and the S&P 500 have a sharp increase in gradient after the money printing started, for the FTSE 100 there is no increase in gradient.
Well, the FTSE 100 is a particular index which is really not reflective of economic growth, is it? I don't think, because it's basically commodities, oil specific, and non-UK, in fact. So it varies a lot with the dollar, and commodity cycles are totally different to growth cycles, although they may be lagging or leading. But the FTSE 100 is very difficult to draw conclusions on from a national economic point of view, I think. Whereas, as you say, the S&P 500 and the FTSE 250 are definitely business economic driven, rather than global cycle commodities or other sector driven indices.
Yes, so I've just put up there the composition of the FTSE 250 stocks, and the FTSE the FTSE 250 is actually only, I think it's something like 20% or less than that of all the equities in the UK, but it has all the kind of main street stocks. So we see here airlines, high-tech manufacturing, real estate, IT stocks, construction, and then you've got an interesting thing is it's 34% of the FTSE 250 is investment funds. So that obviously itself creates volatility, and whether, because this is just baby boomer money that's just gone into a stock which then is used to buy other stocks, as the general stock market goes up or down, there's a whole 34% catalyst here. And then you're right, the gentleman who just spoke was right in that these are more mainstream stocks, a better reflection of what's going on in the real world. Whereas with the FTSE 100, that's only is dominated by just 10 positions. As the top 10 stocks of the FTSE 100 account for about 50% of the entire FTSE 100 and 40% or something of all stocks in the UK. And these top 10, they're all very defensive. Their revenues are mostly international, and also they're very defensive things like pharmaceuticals, commodities, utilities. Sorry, this is the right one.
Can you bring up that list of the top 10 again? The individual names, Rogue. Because the thing is, what strikes me is how much sort of idiosyncratic risk there is in that. We know that BP and Shell have been deeply out of fashion for a decade now. They've had a good couple of years, but before that, they were going absolutely nowhere. HSBC has been fined so many times. Banks have had a very poor decade. We've had BAT, which is in terminal decline. Frankly, it's had remember 5 years since in the last 5 years, I'm sure this share price is down a lot. I mean, I remember losing quite a lot of money on it. And then AstraZeneca and GSK, I mean, I'm not sure about AstraZeneca. I'm amazed that it's now three times the size of GSK, because GSK has had a poor decade. So you've got a lot of idiosyncratic risk there. It's not really very representative of the UK economy at all, which is Simon's point.
Yes, what they are though is they tend to be traditional defensive stocks though. So
well, oil is a cyclical.
So we have here's the FTSE 100. Well, here's the top 10 of the FTSE 100. So yeah, a quarter of it is oil, which is, as you say, is cyclical. A quarter of it's pharma. The tobacco and liquor, that's fairly defensive. Consumer staples is very defensive. But it's a very different competition to the FTSE 250, and that I think explains why there's a difference in gradient between those two indices. Yeah. So now the main thing that's happened is since around 2009 is the current form of economics, that's the economic doctrine of the central banks and the governments. Now, I started to research. Okay, what's the name of the economic policy of the Western governments at the moment? And the best it's difficult to get a clear answer actually, but the best I could get was what's called New Keynesian economics. And New Keynesian economics, according to this doctrine, the central banks believe that they can use low interest rates typically, and then money printing to control inflation, to meet their targets, which are 2% inflation and GDP growth of 2% a year, whilst maintaining low unemployment. And actually, I was doing some digging into that earlier today, in fact, and they actually they really do have Excel spread, some mathematical formulas which they call dynamic stochastic general equilibrium. And basically these are Excel spreadsheets essentially, which the central bankers use, and they really do believe that they've got these spreadsheets, and they really do think that in a controlled manner they can meet their objectives of 2% inflation and 2% GDP growth with low unemployment. And so anyway, so I call that New Keynesian economics, but I stand to be corrected by anyone in the chat here. But anyway, this is the doctrine that's manifested itself, and whoops, sorry. So here we have some macro indicators, and you see that since 2009, they were here all of a sudden. They had this massive, this quantitative easing and low interest rates, and that was actually effective in keeping the FTSE 100 elevated and also GDP elevated. So now to then, so here I actually go through quite a bit of detail there, but I like to then summarise just on this dashboard the most important things. So inflation, the target's 2%, but we're currently at, by my calculation, 4.8%. Now, I don't like to use the year-on-year inflation because I don't find that very useful comparing with a year ago. So I like to use monthly CPI data, which I then bundle into quarters. And so here's my inflation number currently for the first quarter of the year, 1.2%. And the situation last year was total red alert. I really was myself expecting a massive meltdown to happen last year. Just when I was looking at these inflation numbers, but the inflation is no way as bad now as it was last year, but it is still a bit on the high side. And also, however, I think that the government probably might be quite happy with a 4% inflation for a while, because that would then inflate away their debt, because the government has a lot of debt. But at the same time, it's a fairly concerning number, really. But but the trend though is improving, but still in terms of inflation, it's definitely a bit of a alert signal at the moment. GDP growth is fairly flat, to be honest. I mean, it's 1.6% if you work it out from the. We had 0.4% in January, 0% in February, so it's fairly flat, but not disaster levels at the moment. The real bright spot is unemployment. We have very low unemployment, and that's just the magical thing of these current times. So yeah, so my kind of, in terms of where we are against the objectives, I say we're in a situation of prolonged stagflation, and actually, if I can find that. So yeah, so I've plotted here inflation against real GDP, which is GDP growth, but then you take away inflation to then see what, in relative terms, the actual GDP is. And as you can see, this, as far as I'm concerned, is we've been in a stagflationary period now for over a year, and I say that we're currently in a situation of entrenched stagflation. Now, the thing about the government's behaviour with its new Keynesian economics is that's only been enabled by several things. So one is we had lots of deflationary forces over the last few decades, particularly the growth of technology and globalization. And so that enabled the governments to embark on all the quantitative easing without it causing the runaway inflation that it would in previous decades. And another thing is we have a reserve currency. Now, I had to quickly double check that, because it almost seemed a bit ridiculous to say that the UK has reserve currency status. But if you look here, actually, of all the reserve currencies in the world, the UK is actually, pound sterling is actually 5% of all world global currency reserves. And actually, people are favouring the pound sterling only increasingly over the last 10 years. So we do
I'm
believe
amazed,
it.
actually.
Say again.
I'm amazed. The share of global transactions in sterling has actually been rising. Amazing.
Yes. So I was surprised by that too. And but there you go. We do actually have an artificially strong sterling. Not to the extent, obviously, that the US has that advantage, but still, that does allow us to get away with something a bit. And however, these things allow the government to behave with these loose policies in a way that more kind of normal countries without that advantage wouldn't be able to do. And that's why, that's why our when we lend money, we can do so at a much lower percentage, whereas countries like Turkey or somewhere, they have to endure much higher borrow rates when they borrow money. So so this is also reliant on government debt and fiscal deficit. So I do keep a track of government debt and fiscal deficit. And although those numbers are actually fairly enormous, currently the government has about 2.5 trillion in debt, which is about 99% of GDP, and the fiscal deficit is typically about 0.2 trillion a year. However, when you compare that with pre-COVID times, which I've got here, that's actually fairly normal. Actually, when COVID happened, the government became 20% more indebted as a proportion of GDP. The government became more in debt by 20%. But since then, we've stayed along track. So although the raw numbers look terrifying, it's actually probably okay. And so the main point is then that we're in this entrenched stagflation, but things are kind of maybe not so bad, but there is inherent risk of currency collapse or say something like a recession or some worldwide recession or something tipping us over. But other than that, so we are kind of chugging along, not as bad compared with last year.
Can I just come in? Because on the stagflation front, we have had a one-off inflationary surge. Now, the inflationary surge can be traced to two things. First of all, we've printed a lot of money, QE, prior to so during the pandemic, and QE even prior to that. So, and the thing about QE was the expectation that money would not go into the economy. But secondly, also had this huge surge in energy prices during the pandemic, and actually primarily caused by the war in Ukraine. Now, that feeds through to everything in the economy. I mean, the economy runs on energy. And so that surge in natural gas prices will have caused knock-on effects throughout the economy. And we've seen that in food. I mean, food is a function of fertilizer prices and, the cost of heating your greenhouse. And so in Europe, we've seen an extraordinary rise in food prices over the last year. And as the natural gas price comes down, we've seen fertilizer prices come down. That should normalize. And so I don't think we're in an extended period of stagflation. I think we're in a period of stagflation, but the Bank of England now has to raise rates to the point it breaks the inflationary mindset. And so what we have now is this dance between companies who are trying to raise their margins to protect themselves against rising prices, and employees who are trying to get higher wages to protect themselves against rising prices. And both of them, companies and employees, they can't do that. They have to accept that they have lost purchasing power. And you'd hope that over the coming quarters, both company price rises and wage rises fall back to normal, and then the inflationary surge should pass. But we know that food prices should have peaked, and energy prices certainly have. So you'd expect inflation to come down over the next few months or quarters, and as it comes down, wage pressures to abate.
So you could summarize that as you're expecting full-on recession. Oil prices will go down.
Actually, not necessarily full-on recession. What you're expecting is the inflationary surge to pass.
To be transitory, dare I say.
Yeah,
to be transitory,
exactly.
dare I say.
Well, transient. We don't use transitory. Transitory is phases of the moon. Transient is passing, but of an unknown length, period length.
I mean, while we're on topic, I've got there the inflation versus the Bank of England, the Office for Budget Responsibilities predictions versus what's actually happened. But we're still, year on year, we're still up here, you know, quite frighteningly high. And if you look at the slope from 2022, that's quite a shallow slope. But also, you know, when I look at the inflation versus real GDP, assuming I've done my maths correct, that to me is stagflation of exceeding a year time period.
Yeah. Now, I agree on that time scale. You absolutely have had stagflation.
So, yes, so something I'm very conscious of, I think we could perhaps say at this point that I'm kind of arguing, my kind of pet theory at the moment, I guess, is kind of long-term stagflation for quite a long time without us being able to get away from the inflation. Where you're saying there's going to be a traditional response in pricing pressure and.
Well, the thing is, Rogue, this is, I think, the core of the argument, because to me, you know, all these kind of using charts, they ignore human agency. And the Bank of England is there to bring inflation under control. And if they execute on their mandate, they will keep on increasing interest rates to the point it hurts. And it brings inflation back under control. Now, actually, that should read 4.25% on the UK's interest rates, by the way. That we have a huge outstanding debts. And as those higher interest rates come to affect the outstanding debt, so when debts get refinanced, or if they're floating rate debts, then the higher interest rates affect them immediately. But the vast majority of debts are, you know, fixed term, and when they come to be refinanced at a higher rate, then you get a reduction in demand as people spend more on interest and less on everyday goods. That slows demand, slows the economy, and inflation comes down. And so it's just a question of how high the Bank of England needs to raise rates.
So, okay, so I've what I'm tracking in terms of the strength of the pound is I look at the pound sterling against the Swiss franc, and we actually became 10% poorer as a result of the government policies during the COVID lockdown.
Mm-hmm.
But then since then, it's been fairly stable. And there's also yield curves, and this is the Japanese yield curve. So this is what a yield curve's supposed to look like, and this is the yield curve for the UK, and we've actually only recently flipped into being fully inverted. So the orange line is 6 months ago, the blue line is now, and we've flipped into full inversion. So I've learnt from your macro checklist how inverted yield curves are a harbinger of incoming recession. But also there's the kind of, could be a currency collapse risk. So, so it's funny because the yield curve's been inverted, or well, for example, the US yield curve's been inverted for quite some time. And then we've kind of all become used to it. I mean, I know it's inverted, but I kind of forget about it, and I get distracted by whatever's going on in the current week. But it's still there as quite a big present danger. So really, I can kind of summarise that. I feel like the situation's improving in terms of the macro indicators, which could explain, upside in the FTSE 100. At the same time, I'm cautious about these risks particularly in terms of the strength of the pound sterling, and is there going to be a worldwide recession after all, which will then flip us into recession. So,
well, hang on, Luke. When you say the strength of the pound sterling, the sterling has weakened very substantially over the last few years. Against the dollar, we used to be what, 150, 145, and now we're 120 on a good day, 125.
well, I think you'd still consider the pound sterling to be a relatively strong currency, I think.
Okay.
So, name me stronger currencies. You wouldn't be able to name many.
Well, it's all. It's when you say strong, you're talking. Are you talking about strengthening or stable?
Yeah. So what I mean is, if inflation got out of control and the government got to a point where it could no longer print money to get itself out of trouble, or to bail out banks, or etc., without having to pay without having to pay unacceptable rates, then it would be like a currency collapse. So that's kind of what I mean. Becoming endangered, like the the Argentinian currency is, or something, or the Ukrainian currency is at the moment. So yeah, there is a certain risk that of some serious currency debasement. But like I say, it's only like a risk. It's not. I'm not saying that's what will happen. It's just that there's a particular risk. We've got some data here. Someone's just posted in the comment section some data.
No, I was just making a point about actually the Mexican peso. So Mexico, during the pandemic, didn't do huge fiscal stimulus because, they're an emerging market and they didn't feel they could. And, obviously the UK and the US and everyone did enormous QE and enormous fiscal. And hence, the Mexican peso has been strengthening against the dollar. So, when we talk about currency strength, if you print a load of currency and spend a lot of money, you create inflation and devalue your currency. And Mexico has not done that, and so although it's an emerging market, their currency has strengthened over the last few years.
And down here we've got the Mexico's budget deficit is about 4% of their GDP, whereas the UK has about 6%. So what happens is,
the point is that during 2000, they had 4.6%, and we had 15%.
And we've got a comment here from Muscle Riot. So Muscle Riot says that inverted yield curves. Banks cannot function to inject credit under an inverted yield curve with high short end and low long end yields. Banks have to borrow short and lend long and make money from the spread, hence the recession predictor. So I think that deserves a thumbs up. But my main point is that the UK and the US governments in particular have. So when we look here, we can see they've done quantitative easing galore and having low interest rates. They're only allowed to do that because people trust their currencies more than anyone else's.
Yeah,
and
true.
So they allow them to indebt themselves. So so the UK can run with a debt to GDP ratio of 100% because people kind of trust us. So that's really. I think it's unlikely that there is a big currency default, but it's a risk that's worth monitoring. So actually, a good question though. Back up to the yield curve. So, okay, so last time there was a big recession, we had the inverted yield curves. So last time there was a big recession. What happened to make the yield curves go normal again? And how did that relate to the recession and then economic recovery?
Well, okay, when we look at the yield curve, what I think is really noticeable about the UK yield curve as opposed to the US yield curve is how flat it is. And so, when you're talking about the UK 50-year, you're now talking about 3.8%, and the UK has an inflation target of 2%. And if you'd been looking at that yield curve, 2 years ago, then the 50-year would have been yielding less than 1%. And so we've had actually this big change in the expectations for UK long-term rates. And if the UK gets back to 2% inflation, then you would hope that the long end comes down, because otherwise you're talking about the UK entities, the UK government having to borrow at the best part of 2% real. And that means the UK would pretty much be bankrupt long term. I mean, we've got enormous amounts of debt. That would really suck demand out of the economy. So all new projects would have to be being funded at more than 2% real. And, the UK housing market in particular just can't function at these level of interest rates. So what the bond market is saying is that it doesn't believe the UK has got inflation under control currently. And that, if that is the case, then I just don't think the economy adds up, because, all the debts that we have would need to be refinanced at this much higher rate of interest. And I think that, it just doesn't work. I mean, the housing market in particular, you've seen that the average mortgage in the UK, we've gone from 3.8% a couple of years ago to 6.6% and more now. So unless house prices come down a long way, then houses in the UK just become unaffordable. And so in answer to your question, what normalizes the yield curve? What normalizes the yield curve is inflation coming right back down and inflation expectations normalizing. Now, what's happening at the moment is that inflation expectations are way too high.
And there's a problem of as well, obviously recently with the, you'd think that high interest rates would be good for banks because they can make more money out of people, but actually the increases in interest rates have been creating a panic in the banking sector. So is there a limit to how much you think banks can increase interest rates without...
This is a really, really important point, and this is Musselwhite's point, in that it's not just the absolute level of interest rates, it's the shape of the yield curve. And so what is the problem currently is we have an inverted yield curve. So we have high short-term rates in the US, as you've shown in your chart, and lower longer-term rates. And that means banks are borrowing from depositors, or actually the Fed, at high rates, and then they're trying to lend it out at lower rates, and that destroys their profitability. So that's why bank profitability is undermined. Higher long-term rates, lower short-term rates, so a steepening yield curve is the best scenario for banks, because then they pay a little on their deposits and then they lend at higher rates later, longer term.
So how this current banking crisis then, how likely do you think that is to develop into a full-on Lehman Brothers?
Well, I'd be very interested in everyone's thoughts on this. So my own thoughts are that the big banks in the US and in the UK are absolutely fine. In fact, the banks in Europe, I think, are almost certainly absolutely fine, because what's happened since the great financial crisis is that large banks on both sides of the Atlantic have been forced to be much more prudent, and they hold a lot more capital. The situation in the US is very different, in that the regulations in the US only really applied to banks above a certain asset size, and so the smaller banks were less heavily regulated, and they have got themselves into trouble. I mean, if you look at what's happened to First Republic Bank, Signature Bank, Silicon Valley Bank, they've all done, weird things, frankly. Silicon Valley Bank just you know, lending to startups on commercial terms when, so to give you an example, in the FT had a story about how Silicon Valley Bank had lent money to an unprofitable drone startup at LIBOR plus 1%, and this company then went bust. That is not a commercial loan. That's a private equity style loan. The private equity takes 30% of the company and has huge upside. A bank should not be making that loan, and regulators should have stopped Silicon Valley Bank from doing that. Now, the wider question is, how much of the kind of this silliness is hiding in the smaller US banks? We've seen that First Republic Bank was taken over the weekend. Shareholders were wiped out. Bondholders look like they're going to get 10 cents back on the dollar. Yeah, currently, from the data I've seen. Now, what that means is that all the small US banks, they're going to have problems getting funding, and the funding is going to be more expensive, and that means they are going to find it difficult to make loans. There's going to be a credit crunch. Credit crunch will affect the US economy. Now, the extent to which there is a systemic banking crisis, I just don't know, and I'd be interested in what everyone else has to say. I mean, Simon W. is comparing it to the S&L crisis. Now, the S&L crisis was, again, this systemic crisis where, unfortunately, Reagan made the decision to try to loosen the regulations on these small US savings and loan companies and try and allow them to grow their way out of trouble. And instead, they grew themselves into trouble, and they had to be bailed out by the taxpayer. Now, in this case, we just don't know what sort of silliness they've got up to over the last couple of years, basically. Yeah, no, on Musselwire's point, the economist Nero Urbini says the higher interest rates will create severe problems because of the huge debts and zero interest rates QE for 14 years. Frankly, Musselwire, that has been my opinion for the last year, and this is the reason I got out of equities when I did, and I got into long bonds, is because I thought higher interest rates would affect the huge volume of outstanding debt and lead to much higher debt servicing payments, suck demand out of the economy, and cause a recession. It hasn't worked like that so far. It doesn't mean it won't. And I believe that it will with a lag, but those lags have been much longer than I expected, sadly.
So, yes, and Dan Leeds 1980 had a point there about the market cycle. So in my charts, I was showing the traditional market cycles, and then how they came to a halt as soon as the QE started. And then Dan Leeds says that the reason for that is that the basically the central banks were using money printing to stop that from happening, to achieve that, but that we've now run out of road, and that
Well, could you bring that chart back up, please, actually? Because I think on your point and Dan Leeds' point, if we kind of go through what happened at each of those points, we've had the QE has kind of, as you say, we've smoothed out the cycle, and we could smooth out the cycle as long as inflation didn't get out of control. Because then, we could print money, the central bank could cut interest rates to zero, and cut interest rates to zero, the Bank of Japan cut it negative, as did the Swedish Riksbank, I believe. And then everyone did QE. And the central banks, as an explicit point, targeted getting equities back up because they wanted the wealth effect. Yeah. So as the economy slowed, because inflation was low, they could pump the economy full of money and get everything back up. This time, because inflation's high, they can't do that. And so that's why I don't think the FTSE continues along that line, because this time is different. Interest rates are higher. Now, actually, I've got a chart in the coming up in this week's weekly, and let me see if I can show. I should. Yeah. Okay. Let me see if I can share my screen now. Actually. Let me see. Can people see that? This is from this week's weekly. Okay, coming up on Friday. And what this chart shows is the US ISM manufacturing index and the Fed
It's
funds
not.
rate.
I can't see that. Oh yes.
If you
Okay.
you have to click on it.
Yes.
You have to click on it.
Okay.
Can everyone see that? Okay, so
Yeah.
it's the ISM, which is the grey line, and Fed funds. And the point is that if you look at when the ISM goes below 50, and particularly when you go into a recession, the Fed starts cutting rates. Yeah. So if you look back in 1992, ISM goes negative, Fed cutting rates. Then in 2001, ISM goes negative, below 50, and the Fed starts cutting rates. The same in 2008 and the same in 2020. This time is different. This time, the ISM has been negative now for a few months, but the Fed is still raising rates because inflation remains elevated, and hence that's why I think we have a hard landing, basically, and why your chart of the FTSE, I think, turns down, because this time monetary policy is not going to be supportive.
Okay. So I'm clicking onto the live. Wow.
Wow. My God, you should be in Tate Modern.
That's better, isn't it?
Yeah.
So, so you're expecting the FTSE 100 now to basically go down 4,000, 3,000. I mean, actually, yeah.
No, I don't know. I don't make those sort of predictions. I've got no idea. But it's going to be lower than it is now. That's it.
So I think that I would say if we've run out of road, like we're talking about, and this new Keynesian economics system doesn't work anymore because we've pushed it to the limits, then I'd agree. I mean, there's no way to countenance really what the outcome would be. But I'd think that maybe it'd be like a jump down like we had. Well, because there is the back to the old school model where we'd basically return to how things were. So there'd be like a correction and then like a return to how things were.
Well, the thing is, what I would just observe is in all the downturns like 2000, I think that if there's going to be an analogy, it's with 2000, because we've just had ridiculous overvaluations in some sectors. But you see how long it took for the FTSE to come down over that period. You know, bear markets don't happen instantaneously. They're a process. And so I'm expecting 18 months of pain. Not, the 2019 or 2020, where you just had this one-off collapse. I'm not expecting that. I think you have just a general grind down.
Because it would take a long time if basically the entire economic system is going to have to be reworked, reconfigured. That's something that will take a decade, or for at least 5 years. It's not something that can just correct itself in a.
Well, the thing is, I think that recessions are self-reinforcing processes. So what happens, my view of how recession develops, is that you have a slowdown in the manufacturing and construction sectors. They start to shed jobs as people leave employment. Then their spending reduces, and that reduces demand in the rest of the economy, and slowly other sectors start to shed jobs, and you get this negative reinforcing cycle as people are made redundant and cut their spending. So, and that all just takes a while to play out. And in this particular case, the problem is inflation, and the Bank of England needs to be sure that inflation is coming down before it cuts rates. So as the economy slows, the Bank of England will keep rates higher than they need to be for longer, and so that drives the economy into a hard landing. That's my kind of view.
Yeah, and I certainly think that inflation will carry on, and they won't be able to just reduce rates immediately like everyone seems to be saying at the moment. But then I guess the question is, will that then turn into a full-fledged recession, or could they just carry on going for a few years and the data corrects itself more gradually, avoiding a recession?
I've been forecasting recession for a long time now, and I've been absolutely wrong. So the economy has been much more resilient than I expected. However, one of the things that the reasons the economy in the US, and the economy in the US is the one we really follow because it has the best data. The reason they're being stronger than I've been predicting is in part the fact that the Biden administration has been really fiscally irresponsible. Although the economy is doing well now, they've increased the fiscal deficit to, I believe, about 8%. And that's just totally unsustainable. And so now they're kind of running into the debt ceiling, and the Republicans are going to make them cut that. And then you've got, so in the second half of the year, fiscal spending should slow, and that will add to the problems of the US economy.
So I'm just going to wrap up the little presentation, and then we can move on to more general questions and answers. So my final so when I zoom into just like the last 5 years, you've got to remember that the FTSE, that's the FTSE 250. So when I look at the FTSE 100 the last 5 years, so here's the long-term chart. Here's a long-term chart for the FTSE 100, and here's the same thing but the last 5 years, and we see the green line there. That's a long-term line, and we've got to remember that only 30% of the revenues of the FTSE 100 are from within the UK. 20% to US, 50% rest of the world. Like I showed earlier in those in that pie chart, the FTSE 100 is mainly really defensive things
Mm.
that I would argue would do quite well in stagflationary periods. The majority of them would. So, given that particular makeup of the FTSE considered and everything, my kind of gut feel at the moment is a kind of carry on regardless, but with a high risk of recession or currency crisis, giving us this upset which you are predicting.
Well, the other thing I'd say, Rogue, is that what's really surprised me about equities all around the world is you would expect that higher interest rates would cause equity markets to fall. Because in basic terms, why would you invest in, let's say, GlaxoSmithKline, which has got, I don't know, a dividend yield of 3% and is going absolutely nowhere and is risky, when you can get 5% in the bank? So you'd expect people to be taking some money out of the equity market and putting it in the bank or putting it in bonds, which yield much more, which yield more with low risk. And what's been really surprising on both sides of the Atlantic is that equities have held up as interest rates have risen, because you'd expect the discount rates rising, and therefore, the price of equity should fall because you're discounting future earnings at a higher rate. But that hasn't happened.
Yeah. So the FTSE 250, we mentioned before how that had behaved differently. Again, after QE, it tended to stay in line without having bubbles. It just stays on this one more line, perhaps this one big bubble, you could say, but still, it tends to just keep in trend, with the exception being the Corona crash. But then we did have a dive back down last year, so which actually corresponded with interest rates. So that's an interesting fact. There is that the FTSE 100 stayed, even when interest rates started going up, the FTSE 100 just went back to that trend line, whereas the FTSE 250, when the interest rates went back up, it actually crashed. So that's an interesting. But all the same, the FTSE 250 is more all kinds of main street stocks, and I've just got no idea how to call the FTSE 250.
So, Roy, can I just ask you what your after what are your takeaways from the work you've done? How are you gonna change your asset allocation over the coming year?
Actually, right when that's exactly our next slide. So
okay.
So the reason I do this is to decide what percentage of my portfolio I want to be in risky stuff, and currently my target stance is 30%, and my current risk allocation is 26%. So I'm still within my target, and I've decided to maintain at just 30% risk for another quarter. The reason being, although I am starting to feel like the situation's gradually getting better, actually, and particularly if you were to invest in certain sectors, particularly in terms of the FTSE 100, I to kind of look at this carry on regardless as appealing at the moment. But there is still some big risks. We looked at the yield curve. There's still some big risks. So on that basis, I'd rather just sit and wait. I've got a very defensive portfolio at the moment, and I'm happy to sit on my hands for another quarter, get more data, and but I've kind of in my mind I want to start moving into a bit more risk, maybe the third quarter this year.
Okay, well, I disagree with you. I think that the data is definitely deteriorating. So, if we look at what happened today, the reason the equity markets have sold off about 1.5% in the US is that we had the JOLTS job reports, and they showed that the number of job openings was falling and falling quite quickly. Now, the US labor market remains tight, but it is weakening, and crucially, the Fed is still tightening, and that means demand's going to fall. You expect the number of job openings keep on falling, and one of the things that's been slightly mystifying is that leading indicators have been negative for quite a long time now, but economic activity has remained pretty decent. Now, at some stage, I think economic activity catches up with the leading indicators, and we have a slowdown in the second half, and that is not good for equities. Now, Musselwhite has said, what are the risky sectors? And I think they're the cyclical sectors, basically. So, traditionally, manufacturing, transport, materials, basic materials, oil and gas, banks. As the economy turns down, you would expect all of those to get hit. And I have been struck by the fall in the oil price today. The market feels that the economic data is deteriorating and the demand for oil is going to fall in the second half. And as we know, the oil has very low price has very low price elasticity. So changing people use their oil whatever the price is. So demand causes a drop in the demand causes a big drop in the oil price. Rogue, any other stuff you want to discuss?
Sorry. Actually, one sector I've been looking at lately is the consumer staples sector.
Yeah.
And I'm just need to get some data up for that. But actually, that was a sector that when I looked at previous market cycles, it tends to do well. Right, actually not basically throughout basically the whole cycle almost. So it's kind of one which you can jump on. You don't have to worry about your timing so much. So you could actually kind of wait for the shoe to drop and then go in, safe in the knowledge that you've got quite a good run up. But also because if we are going to have lots of inflation, these we're talking, companies like Unilever, who they're practically monopolies. They're no one can compete with their economy of scale, and obviously all of their capex is, they've got all their factories up and going, so it's kind of relatively inexpensive for them to keep going. They've just got to kind of take account of the amortization of their production lines and things. But they, with inflation, the cost of everything everyone needs, even in a recession, toilet roll, tampons, baby wipes, whatever, everyone still has to buy that stuff. And what I've noticed when I've been going to the supermarket is all these basic things are more expensive, but because their actual nominal price isn't so high, you kind of overlook it. So whereas if I'm going to go and buy a couple of packs of bacon, and I notice the pound's gone up, the cost's gone up a couple of quid, I kind of have a good think about whether I should get an alternative. You don't really have the same thing with consumer staples. So I was
Well,
just thinking, would consumer staples be a good sector to invest in now, or
yeah.
perhaps after the shoe drops?
Well, can I just come in there, actually, Greg? Because the thing about consumer staples is they've done incredibly well. And they have also, one of the reasons they've done well is they've managed to protect profit margins. In fact, based on the recent earnings reports, some of them have managed to increase margins. And that works okay as long as we're not in recession. But the trouble is, when we go into recession, people become increasingly price sensitive. And so, when they've got enough money, they'll buy Colgate. When toothpaste, when things get tough, they'll go down to Aldi and buy, Aldi's own at 50p a tube, as opposed to £2.50 for Colgate, or £7 for your extremely tooth whitening toothpaste. And I just really wonder whether all these consumer staple companies which have increased their margins or kept their margins, whether that is they can continue doing that if the economy slows. I mean, I don't know about you, but I go to Aldi occasionally and I stock up on razors and other things which are kind of generic, and frankly, I really don't see the difference between Aldi's toothpaste and Colgate or whatever, and I'll go for the cheaper thing. And I'm a fully paid up member of the middle classes, and I suspect a lot of people will do the same as tough times start to hit.
Yeah, I had you more down as a Waitrose man.
I've been to Waitrose and I've seen the price of cheese, and frankly, I went round the corner to Aldi.
I must admit, I do often nip into Wilko's. Some things like razor blades are, it's worth shopping around. But yeah, I mean, it's always scary to invest in something when when this is the chart, and maybe it's safer to wait for the shoe to drop first, because when we look at the last, when we look at the credit crisis, once once we'd got through the bear market, you could invest in this fairly early on, and it just kept on doing great all the way through. And the same with the dot-com bubble as well.
Okay, where I'm going to push back on consumer staples, actually, thanks for bringing up that chart, because you kind of it's crystallized the problem I have with that idea, is that where's the upside, where's the downside? So if you buy consumer staples going into recession, yeah, the best possibility is the share price holds up. The worst possibility is it falls by 30%. So there's an asymmetry to that trade that I really, really don't like. Now, Simon W on in the chat has just said utilities. Actually, I think that's a much better trade, because utilities, very low revenue growth, their earnings should just grow with inflation. But as the economy goes into recession, you know that their revenue is going to hold up, and they should trade like a bond. And you'd expect at some stage the Bank of England or the Fed to start cutting interest rates, and that should mean that the share price of utilities holds up. Everything else, mean, we've talked about this before, but my general feeling about equities is they are incredibly dangerous, and a 30% drop in share prices, I mean, is very damaging to your wealth, and therefore, unless there's an asymmetric upside, so the risks are much greater to the upside than the downside, then don't invest in equities. And right now, I see them at risk as very much asymmetric to the downside. Dan Leeds 1980 has also said insurance. Yeah, again, I think that's a good defensive sector as well. So have you got the rest of your money, Rogue?
Well, I don't like to disclose in the public domain my actual positions. But I'm only 30% risk, is what I'll say. Defensives, I'd count, for example, things that I wouldn't consider risk would be cash, bonds, gold. In my case, I have a uranium position, which I don't mind talking about, which I don't consider risk, but that's only because I've got a very strict stop loss on my current position.
But actually, I think you've just raised an extremely good point there. Gold. Because you notice, and let me see if I can bring a gold price chart up. But you're seeing that today, when equity markets are selling off, gold had a really good day. Yeah. And the current situation where we know there's been huge amounts of money printing and that there's a potential financial crisis brewing, and there's a budget debt ceiling in the US possibly leading to a default, all that incredibly good for gold. And so I think if you want to hide out somewhere, I think you should have a bit in gold, frankly. I do.
So I've actually got there's a YouTuber called Sovereign Citizen. No, sorry, he's called Sovereign Saurus. So there's a YouTuber called Sovereign Saurus, and he actually was commenting on my videos. So maybe we could get him to join us one time,
right?
Because he's a real expert. I've got here the gold chart. Actually, this is going back to 2007. When you go back to 2007, it looks pretty good. This is gold against the pound sterling.
Yeah.
And we have broken north of this technical pattern.
Yeah.
But
also, it's done this. It's had this bull run. It's done okay recently, despite the Fed and the Bank of England raising interest rates, and that should be really bad for gold. And it's been just fine. So gold looks good to me.
I mean, what I like about it is the US dollar, the US confiscated Russia's foreign reserves. So that has got to be kind of bearish for the US dollar and all of these rogue states. It makes sense that people start buying gold for their their reserves rather than the dollar. And just general, there's general inflation. But yeah.
Now, actually, while we talk about gold, the last time I invested in gold, I also invested in a load of gold miners, and frankly, I had very mixed results. if anyone likes any particular gold miners, can they put them in the chat? Because I mean, the reality is that gold mining stocks you'd expect to be geared to changes in the gold price, but my experience, they weren't really. They were kind of they kind of more reacted more to just equity market. They followed the equity markets rather than gold. Yeah, Dan Leeds 1980 is saying just buy an ETF of gold miners. That is frankly the best idea, I think, rather than dabbling in individual stocks.
Yeah, I'd agree with that. It seems to me you've got to worry about the gold commodity, which in itself is a horrendous task. Plus, then on top of that, you've got to worry about, market cycles and whether the asset managers are pumping money into gold explorers or not. So there's too many moving parts to stock pick.
Actually, so both Simon W and C Wyatt on the chat are recommending mining royalty companies. So Simon W has been talking about Franco-Nevada and C Wyatt's talking about Anglo-Pacific, and those are really good ideas actually, because then you're not exposed to the profitability of the mining company. As long as that mining company is producing gold, then it has to give some of that gold to the royalty company. And so the royalty companies can be thought of financing companies that get paid in gold rather than in cash. And as long as the gold price is going up, they should do well. So I think those are really good idea.
So
Yeah.
I mean, I've actually been looking at Greatland Gold lately, because it was a subscriber pick, and out of all the subscriber picks, it was the one that made sense the most, but not particularly. So it's not so much that I'm just going in to buy a gold stock. It's more that was the best stock of all the subscriber picks I got, but landed to me. But they're kind of actually. So this is a classic gold prospector. So they just had gold prospecting rights back in 2019. And you can see how the share price pumped massively to the end of 2020. And since then it's been crashing. But the ironic thing is the best news flow they ever got was right here at the peak, the end of 2020, when they essentially got an agreement to develop the mine, and they're now actually building the mine. They're halfway through completing this mine, and yet, as you can see, the share price is just crashing. So it just goes to show what a casino they are. The same as with oil explorers. It's a case of just pretty much randomly buy 20 at the earliest stage, and half will go bust. Half of them you'll make some money on, but it's not really my kind of thing, really.
So the thing is, Ray, that actually, this is a chart. I posted in the chat the life cycle of a mineral discovery. Greatland Gold illustrates that very well, in that you have the speculation, but actually you then have this period in which they're developing the mine, but there's no news flow. During that period, then you're talking about years when the company is just developing the mine, burning through cash, and wants to keep people interested. So you then get a decline in the share price that only really bottoms when the mine comes into development. And so I think Greatland Gold's in that orphan period, and the time to start looking at it is when the mine looks like it's about to start producing.
That's great. I mean, that's an excellent chart. Yeah, and I agree with you. I think we are in the orphan period. The funny thing with Greatland Gold is the actual mine is supposed to produce, I believe, next year. But they've got their joint venture partner, Newcrest, Newcrest Mining. They're basically imminently going to get taken over by Newmont Mining. So they they couldn't have everything in the right place more. But then, in a month's time, they could get taken over by Newmont, and then Newmont could decide, okay, we don't want that in our portfolio, and then that's it. It's all for nothing. So that's the kind of frustrating thing about Greatland Gold. Why I haven't gone in, because of the risk of them being taken over, the risk of Newcrest, the risk of their sponsor being taken over, and then Newmont ditching the project.
Yeah. I mean, all these small miners, frankly, the big lesson I took last year. So I did a podcast on key lessons of 2022, which I hope people have watched. But the big thing I learned, and thank you very much to Simon W, who's on this chat, what he taught me was that essentially in all these mineral and oil exploration projects, there's just this over optimism, and so everyone is optimistic. The sponsors, the CEOs and engineers in the company, and shareholders. And frankly, you want to invest when all that optimism is over. And so, frankly, you don't want to be investing in these exploration companies. You want to wait until there's actual production and you can actually do the numbers. So I wouldn't invest in Greatland now. I'd wait until they've got production, you know what the numbers are.
So it was really good to get feedback while I did that, because it's actually quite a little bit stressful, but at the same time, I think very useful, because if you don't get feedback on your ideas, it's very easy to, if you don't challenge your own ideas, then it's very easy to get caught up into kind of pet theories and things.
Yeah.
But that was really useful to going through the FTSE. We can. I'm happy we can open up some more general questions with people if anyone has any more general questions they want to ask.
Well,
how are you?
About Greatland, so while we talk about Greatland, Dan Leeds 1980 on the chat saying that Greatland has a crypto level of fanatical followers, and that is part of the point. When you look at the chat rooms on these small mineral and oil exploration companies, they have these fanatical followers, and they're all over invested, and they're all everyone is just way too optimistic, and the small investors are responsible for pumping the share price up, basically, and you need to wait until people start to get more rational about the prospects of these companies before you invest.
Yeah, when I did my Greatland Gold video, I actually did what I thought was a very positive video. But I didn't. But I kind of said, "Oh, but I'm not going to go in because they might get taken over." And I got a completely deluge of abuse off the fanboys. But Actually, I think though that's a useful way of knowing a bad stock, or it's
Yeah,
kind of almost like a good short signal. Um, is when you get such a big response, and also view numbers. So there have been some companies I've covered which have had, they get enormous numbers of views compared with, I could do, I could do like what you think, a fairly popular stock like BP or GSK. Um, and then sometimes you'll do like a tiny company with a market cap of 500,000, and they'll get as many views as a BP or a GSK. There's just like a fanatical cult following.
yeah.
But I wonder if that could be quite useful data. Um,
No, you're
mm,
absolutely right. It is actually, and they find that the stocks which have the most active internet chat rooms tend to underperform. So your instincts are absolutely right, Rogue. Um, okay, yeah. Actually, C. Wyatt has brought up Pantheon Resources, which I've talked about, and is a very good illustration of that. It's this. Frankly, I've lost money. Actually, last time I've made money on Pantheon, but it's a serial um, disappointment, basically. Maybe post the chart of Pantheon and we can discuss it. So, Pantheon Resources a few years ago, and you'll see I posted the share price chart here. Back in 2017, it had prospects in Texas, and it was meant to be, these were going to be the perfect wells. And I remember that Malky's blog was talking about how these, they had found the golden key and were, going to unlock these great assets in Texas. And stupidly, I bought into the hype. And then basically they had problems with these wells and the share price absolutely collapsed. Well, this time round, and I've talked about it on the Portfolio Matters, this is a company with assets in Alaska so this was, they would need to frack in Alaska. In Alaska, they had huge potential resources, but they had no production. And the market cap hit £1 billion. I mean, it's just absolutely amazing. And, that's all speculation. And, the chat rooms were absolutely full of, how this is going to be an absolute, going to the moon. But the reality is they drilled the wells. Production was disappointing from the exploration wells. And you've seen the share price has absolutely collapsed, down from above £1.50 to 19p. Now, I actually made some money out of it because I sold it when it, the market cap got to like 800 million. I just thought this is absurd, and I actually doubled my money and got out. But you won't in future. Thank you to Simon W. Once again, I've learnt my lesson and I will be avoiding exploration stocks.
yeah, I mean, if there's almost obviously a niche there for you could just go in and invest in them at the right
Well,
market
actually,
cycle, knowing that they're
yeah,
trash, but just to take
yes.
advantage of the stupidity.
No, that you're absolutely right. Yeah, absolutely. There is a time to invest in these, and that's at the bottom of a recession. Okay, when
Mm.
all the crap catches a bid, and to my own sins, Rambler. We're going to bring up the share price of Rambler now, but that went through the roof on speculation. And that's a really good example of how everyone was just way too optimistic. And, I think it's frankly bust now. But
What
if you look at the
here we go.
Yeah, if you look at the share price of Rambler, it's this has been adjusted for stock splits, of which there have been many. But it's the share price back at the depths of the pandemic. Which I'll have to post another one with it just over the last 5 years. But you see that it as the economy came out of recession, the thing about these small companies is that when like the copper price, the oil price is growing and the economy is growing, what I think happens is that shareholders extrapolate upwards. And that's particularly true of these small miners, because the revenues are growing. Everyone thinks, yeah, the price of oil is going to go through the moon, demand's going to go through the moon, price of copper is going to go through the moon, and these things get overbid. And
the major issue with small resources companies is they haven't got any money.
Yeah.
You need substantial amounts of finance to do anything in oil and gas, mining, whatever, and you need that money for quite a long time. So even if you're successful, you're going to get taken out by people with money, and that's the bigger company. The other thing is that you're a small player, so you're never going to get the best bites of the cherry in any acreage, mineral resource play, or anything else. It's very rare that you get a Chariot or someone with a geological thesis that discovers gas off Mozambique, for example. That's one in maybe a 40-year history. But the underlying issue is you don't have money and you have an enormous liability. I once said to a chairman of a company I was managing, a small oil and gas company in Morocco, I said, do you know what your liability is here in drilling these gas wells? And he said, well, we don't have any liability. We're going to produce gas and we'll get the revenue for that. I said, what happens if one of your wells blows out? He said, oh, that'll be insured. I said, unlimited liabilities are never insured.
Yeah.
Sure enough, one of them nearly did blow out and the company was lost. So this is the issue. No money, unlimited liability.
Yeah.
And talking of which, I've got up here Rockhopper Exploration. Are you familiar with Rockhopper at all, Simon?
Oh yeah, that's a long-running history. Down in the Falklands.
Yeah.
Yeah.
I mean, I can remember back in around 2008, 2009, when they were doing their exploration and all the hype and everything and belief, and you can see what happened to the share price. And these were the only one. There were a plethora of exploration company. There was there was Falkland Oil and Gas. There was Rockhopper. There was
Premier were involved as well at one time, I think.
And these were the only ones that had a successful drill. But even so, look at how low the share price is now compared with back in the days when, now they've actually got a proven resource. They just need to find, like Simon said, they can't get the money. They just have getting the money is the problem. They need to get their friends Navitas to find $1 billion so that they can then develop the well. That's where they are now. But back here, when they didn't even have, proven oil reserves, really, you can see how much higher valued they were. It's just staggering.
Well, that's right. That's a very good example of the life cycle of a mineral discovery. As the chart I posted earlier. You want to invest actually before the hype gets going, but when the peak of the hype, you want to get out, because actually Rockhopper is a really good example of, having found it, you need to develop it, and that takes years and lots of money.
And then turning to this Beacon Energy here. So when these companies get to this point here, they are actually still solvent, aren't they? But they essentially just have the rights to the assets only, and they operate as like a guy in a bedroom. Or how does it work once they reach the kind of death phase? How does it still exist as a listed company?
Yeah. Well, this would honestly, Rogue, Beacon Energy, as it is, this is dead. Okay, so last year, regular viewers of Portfolio Masters will know that I covered this. This was it was then called Advanced Energy. They had a project in Timor-Leste where there was an old abandoned oil field, and they had done a new 3D seismic. They thought that the original owners of the field had drilled in the wrong part of the dome, and actually they could recover. They're going to drill into the top of the dome and get out more oil than the original owners. And they estimated the chance of success of finding commercial quantities of oil at about 95%. And, we talked about it, and I had a small position, but not a tiny position. And then they drilled the well, and they found absolutely nothing. In fact, their 3D seismic proved to be wrong. They drilled into a flank, but there wasn't any oil. And so what happened then is, the shares fell like 95% in a day. And as Simon W.'s point, in order to keep on running a company, you need money. And they've got no money. So, the CEO left, etc., etc. They've renamed it. But the reality is they're not going to raise any more money because then nobody's got any confidence in them. So the company will tick along with other new projects as long as the executive need to run down the company and continue getting paid.
Yeah, the other thing to think about is, in your imagination, is that if you're drilling for oil and gas, you're putting a probe which is 6 inches in diameter, 4 kilometers under the Earth's surface. Now, unless you're controlling that, which can be very expensive, the probe at the end of the piece of steel is like a string. In the drilling business, we call it the drill string, and it flops around. So you can't imagine that if you're targeting, say, a 500 square meter box, cubic meter box, somewhere 4 kilometers below the Earth's surface, if it's not controlled so closely and so close to your seismic, that the chances of you hitting that spot, unless it's enormous, are not very high. So anything over 30% chance of success, even on a technical basis, is very, 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 very difficult to achieve.
Yeah. Simon, are there any oil companies you like currently?
What, on the small size?
No, anywhere, if you're looking to invest in oil and gas, and I know there are a lot of people on the Discord who are doing that and very keen on oil and gas because of the medium term outlook. Which companies do you like?
Look for big new basins. So Guyana,
Yeah,
companies that are drilling and close to production in Guyana.
yeah. No, I completely agree with that. So, actually, if you were to ask me, I would be looking at Exxon and Hess for precisely that reason, and because I think during the downturn in oil and gas fortunes, the American producers were under much less ESG pressure than the European ones, and they kept on investing in exploration. Hess and Exxon actually will keep on growing their production over the coming decade because of their new finds in Guyana. Whereas, if you look at BP's production, the share price is doing okay, but their production is going nowhere and falling. And Shell, over the next decade, its production is also forecast to go nowhere. Its oil production will be falling, partly offset by rising natural gas.
Yeah, look for companies that have R over P's greater than 1, i.e. their replacement of reserves is more than 100% of production. And Exxon is one of the few of those around. The other areas to look at are the technical criteria in the basins. So in Guyana, you have very deep water wells, so obviously the companies have to be pretty substantial to afford that. But the productivity and the deliverability of those wells is extraordinarily high. So they can ramp that production up and down, as Exxon did in Q1. They can, with a dropping price, they can increase production quite easily. So they can maintain and play a swing company profile in falling prices, which helps their earnings.
Actually, one company I would like to talk about, and I'd really appreciate if anyone here understands properly, is Petrobras. And we're talking about the Brazilian oil company with ADRs listed in New York because it has an absolutely extraordinary dividend policy. Now, the dividends, if I can see, the last dividend, I believe, was about 50 or 60% of the share price.
Wow.
And
C. Wyatt and JB invested in Petrobras, the dividend, but this company is fraught with politics. And that's the major issue. And you don't know what the politicians are going to do. You're speculating on politics with Petrobras. I mean, the resources that they have are extraordinary, but you don't know what the politicians are going to do with this company, who they're going to put in place to run it, and how it's going to be run. So it's for me, it's a no-no, because you're not speculating on oil and gas. You're speculating on Brazilian politics.
But why is it, given that you're getting a dividends that are like up to 50% of the company, the share price? I mean, why is that? You only have to believe that they're going to do another one, and you get paid out. It seems absolutely extraordinary to me.
But if the government says to the management, don't distribute anything, then you've got no dividend, have you?
No, that's true. That's true. But yeah.
If the government nationalizes Petrobras completely and takes all the dividend for the taxpayer, you as a shareholder, you've got nothing.
Yeah. Okay. Yeah. No, I take your point. Yeah. Are there any UK oil companies you like, Simon?
UK oil companies, UK listed.
Yeah, UK listed.
No, I don't like UK listed companies for oil and gas because of the listing rules and the reserves accounting and transparency. So I would prefer jurisdictions like the US, Canada, or at the limit Australia.
Okay. So can you just explain that?
Yes, historically the UK hasn't had a ground up small oil and gas petroleum resource company base, and the listing rules do not account for regulation of how you report reserves and how you account for petroleum. Whereas the SEC and Canadian exchanges have very strict regulations about how you account for petroleum reserves and resources, and have standards that you must adhere to and be transparent about when you're reporting. So AIM and even the majors on UK listed stock exchanges rely, if they're big enough, they go to the SEC for their quotations and for their reserve-based accounting practices. So if you don't have that as a solely UK listed company, you're very much in the dark as to what's beneath the surface, if I can put it that way. You're more in the dark, and you're less held to account than you are in the US or Canada.
Right. Thank you. That's really interesting. Actually, now I know that on the Discord we have a lot of people who like Harbour Energy. Would anyone like to give us a bull case for Harbour?
Well, I looked at it 3 years ago and I couldn't value it. So that's the issue. In their reporting, the detail and the reserves and resource accounting is not transparent enough for me to take a broad look at the assets and to put a value on them. So I gave up.
Yeah. Well, I mean, frankly, the other thing about the UK, well, North Sea producers, is the energy tax, windfall tax, and until that's been removed, I think they're pretty much uninvestable. You're basically speculating about the end at which they're going to the point at which that windfall tax is going to come off, aren't you?
Yeah, I definitely wish. So I invested in oil stocks in 2021, I think, and I really wish I'd done so in American stocks instead of UK stocks. I just haven't set up a share dealing account that allows me to do that, but which I could do, but I think I'll actually set myself up to be able to invest in US stocks, because there's all kinds of interesting things you can invest in the US that aren't available to us in the UK. AI and stuff, for example. But
Yeah.
oil stocks, though, it would have been much. I would have been much happier with US stocks for the reasons listed, particularly because they're so less affected by all the ESG stuff. I've got a question for Simon, which maybe you can answer, maybe you can't. But when I was, and I think it's maybe it might be exactly what you were saying, but when I was trying to assess the assets that Shell had, I was, I've got here like a chart where I've put together their assets, and I couldn't I expected the oil in the ground to be a big proportion of their assets, but it doesn't seem to be the case. They have 118 billion listed as property, plant, and equipment production assets, but I think that's the oil rigs and things. But there's no, they don't really state anywhere this is the value of the oil we have in the ground. So how is that different in America? If I looked at an American company, would they display their oil resources differently, or is it another accounting thing I've totally missed?
No, a US quoted or any listed company on the US market in its reports will have a reserves resources addendum or appendix where you get a discounted cash flow model of the future reserves P1, P2, and you'd get a statement of quantum of the resources or contingent resources according to the World Petroleum Society of Petroleum methodologies. I'm surprised you can't see that in the annual report for Shell, because Shell is quoted on a US market and it should produce figures based on the SEC rules and regulations for valuing petroleum resources and reserves. Maybe a bit more digging, but it's quite possible that it's buried deep somewhere, but it should be available. Going to your question about the proportion of assets, if you like. Reserves will depend on future discounted cash flows, so will depend on price. So they will vary as price is differently modeled from year to year. They're integrated companies as well, so maybe all the detail is not available, and it's quite possible that production, processing, pipelines, ships, transportation systems, all these kind of assets on a book cost basis are significantly higher than, and refineries, all these kind of assets are significantly higher than the crude oil and gas in the ground.
Right, yeah. So they've got to account for the cost of extracting oil as well as the value of the oil itself when they.
The discounted cash flow valuation of reserves is a net present value model. So the net present value is the commercial profitable value of those reserves once they're commercialized. That is the definition of a reserve, as different from a resource or something that is readily commercialized and close to production.
Right. Well, thanks for that explanation. I'll go and have another look at the bulky Shell annual report and try and tease out the extra detail.
Yeah, have a look also at the Society of Petroleum Engineers World Petroleum methodology for reporting reserves and petroleum reserves and resources, and that'll give you an idea of what most companies should adhere to in reporting their reserve bases.
Great. Thanks, Simon and Rogue. Now, actually, we should be starting to wrap things up. We've been going for a while. But before we do that, I posted in the chat the share prices of a couple of oil service companies. And what I like about oil service companies is that there's no exploration risk, and they are highly cyclical. So if you know that the oil price is going to go up, then these companies are highly geared to the oil price. So right now, with the world economy slowing down and I believe going into recession, you want to be avoiding these like the plague. But when the economy bottoms and the oil price bottoms, then their activity is highly geared to an increase in the oil price. And so when the oil price goes up, their revenues are geared to that and the share price shoots up. So if we look at hunting, the share price bottomed in 2020 at about 130 and it peaked at 330, so you're talking about 150% rise. And in the case of Helmerich and Payne, you're talking about share price that was less than 20 and went up to 60. So share price more than trebled. And frankly, this is a game I'm intending to play again. So when I think the oil price has bottomed, I will be buying a lot of the oil service companies because you don't have the exploration risk. And we know that the world continues to use a lot of oil, but we just haven't been exploring for it. And frankly, I'm expecting that will have to change at some point. So as we get closer to the bottom of the oil market, I'm intending to do another one of these online chats where hopefully we get Discord members to start swapping ideas of what companies will do well. Simon.
Yeah, just a word of caution on particularly drilling contractors that, they are geared to the oil price, but you have to be careful about utilization rates. So in different fleets or different types of drilling rig, there will be different amounts or quantities of these rigs in a fleet. And it will depend on the utilization rate globally of that fleet, say a semi-submersible or a land rig or a drill ship. And it's only when the utilization rates cross over from 85, 90% and above that you get a gearing of profitability for those drilling contractors. Any utilization of a rig owner below that tends to be unprofitable, and they're highly competitive until they can get their utilization rates and therefore their contract drilling rates up into profitable territory.
Right. Okay. Well, when I think the cycle is bottoming, Simon, we'll be picking your brains on which drilling companies you like. Rogue, anything else you'd like to discuss before we wrap it up?
No, I think if we were to do it again, I think the presentation bit at the start a bit shorter, and the kind of discussion of general stocks and things more time. It's kind of quite enjoyable going through random topics that people bring up.
Yeah, no, I agree.
So that's been really enjoyable. A little bit daunting to share my thoughts and getting a bit of a grilling, but that's all very very useful. So I can now go back and have a bit of a rethink about my assumptions. And
Well, can I make a suggestion there, Rogue? So, thank you for the work you put in, and it's great to you to get us started. And but I really like your stock analysis. Perhaps when we do the next one, we could start off with a stock analysis and then go into a general discussion. What do you think?
yeah, that's certainly, we can certainly do it that way. Yeah, for sure.
Right. Okay. Well, thank you all for tuning in today, and thank you to Rogue for all his work. And I hope you found that useful. And we will do it again next month, Rogue.
Yeah,
That work for you?
we can. We'll work out a date. Certainly.
Great.
Yeah, we'll have a chat offline and work out some dates, a schedule.
Brilliant.
And thanks very much. Thanks everyone for
Great.
joining us.
And Rogue, I think, is recording this so with a bit of luck, it will be on his channel.
Yeah,
And,
I'll know within 5 minutes whether or not it was all for Nout or not. But hopefully it's all worked out. I think this time. I did a sound test this time, so we should be good.
Okay, great. Okay. Well, and thank you to all our members for their inputs on the chat, and Simon W. in particular for his contribution. Taught me something about accounting standards. Okay, cheers, guys.
Cheers, everyone. Bye.
Wow.
Please read the disclaimer and remember that prices can go down as well as up.